Let me invite Peter Cardillo, who's joining us all the way from the United States to help us understand what's going on. Peter, good evening. It's a sea of red. India was no different today, but look at Wall Street, maybe seeing the worst performing day of 2021. This is not a correction, or would you say the fears are real at the moment, and this is the trend that's likely to continue, where you will see corrections across asset classes, beginning with the equity markets?
I think it's, the perfect excuse has hit the market, and that excuse is the rise in COVID variant cases, and which is gripping Europe and even in the United States. And so the market, was high. It had high valuations, and this fear factor obviously is behind the decline. And if you look right across the board, I mean, commodity prices are being hit. Oil prices are down over 5, almost 6%. Yields have collapsed. We have the 10-year trading below 120 at 118. And this is all about fear. And so it's a sell-off that I think will not last. I think we can see a quick reversal as soon as the market comes to the realization that even though cases are rising, that we are probably not going to go back into a situation that we were in 6 to 8 months ago. So I think it's a perfect excuse, as I said. And now valuations have been corrected somewhat, and we're in the midst of the earnings season. And so far, we've had earnings that certainly have outpaced expectations, and I expect that to continue. So I think when the noise of the virus begins to cool down, I think you'll see a quick reversal, especially in some of these commodities that have been hard hit, and in particular, the price of oil.
What about the bond markets? If I look at the 10-year Treasury yield, it's fallen below 1.2%. It's something we've not seen it trade at for at least 5 months. A lot of experts out there are saying, look at the bond markets for clues in the US markets. So when you look at this, Peter, what do you make of it?
Well, let me just begin by saying, if we have to look for the bond market, clues for the stock market in the bond market, obviously, with the yields dropping the way they have been, stocks should be moving sharply higher. What the bond market has been telling us, and I don't agree what the bond market has been flashing, is that inflation is not really a worry. And of course, I disagree with that. But now we have the virus situation. And so if you add the COVID variant situation, along with the bond market that seems to be saying that the Fed is right, this is a great opportunity to be buying stock, because I don't think that this is going to be long lasting. The bond market's behavior has been very puzzling over the past 60 days. It's certainly not in tune, I think, with the reality of the threat of inflation, of the inflation that exists, and certainly some of the good, real macro news that we have received. In fact, if you look at the retail sales that came out last Friday, they were much, much more than expected. A good indication that consumer spending is going to continue, and that's 2/3 of the economic growth here in the States.
Okay, so you're a firm believer in that red-hot inflation report card that we saw. Peter, you touched upon crude. I want to come back to that. In fact, the safe haven of gold is also down today. Silver's down. All the commodities seem to be down. But I want to focus a little bit on crude because for us in India, that's so important, being one of the largest importers of oil. What we are seeing today with the agreement that has been reached and the fear of COVID-19 cases, which you call as an excuse, it's an aberration today, you would say?
Well, I think so. And again, look at the latest agreement that they announced yesterday. They're basically cutting down by 400,000 barrels a day. This will last all the way to the end of September. Yes, of course, the week before, the United UAE certainly won its case, and they will be increasing more going forward, and so will the Saudis. But what demand very strong here in the States and even abroad, it's hard to think that this decline is really has anything to do with fundamentals. So I think, again, it got caught up in a market that was in a decline due to the incremental of the baseline production, not the month-to-month production. And so with this fear factor gripping the markets in general, that is the virus fear factor, the market just fell into a technical slip, and it's causing a massive sell orders, that is stop sell orders being touched off, and this is the result. I don't think it has to do with the fundamentals. Absolutely not. I think it's a pure victim of a technical sell-off that I believe will quickly resolve itself.
We're also being joined by Manish Singh, who's going to be talking to us about the global markets. Manish, we also have Peter Cardillo with us. If I could just get your views on what you're seeing as far as the sea of red goes. Peter Cardillo just said it's the first excuse the markets are looking for, which is a resurgence in COVID-19 cases. But, given all the liquidity that we have and all of that, would you just say that this is just a normal correction, an aberration, and that we're still very much in the midst of a bull run?
I think we were definitely very much in the midst of a bull run, which probably will go on for a few years, I should say, given that there is no alternative asset class where you would like to park your money. And if you had, this year I think we've had 39 all-time highs already, again, month of July. So it's no surprise that there will be profit booking at any opportunity, or if anyone has any doubts about where the market is going. But the US 10-year at 1.24% is telling me that the growth is going to be anemic. And I have talked about this in my last newsletter, which is on our website, that how the US growth is peaking. So I think the bond market is clearly telling us that the growth expectations are peaking. And of course, the Delta variant and God knows what other variant is down the line doesn't help the whole hospitality sector recover so soon. So it could be a combination of that. We've had a big rally, so a pause is not unhealthy. I think it's a good thing that we are seeing a bit of pause and a bit of sell-off. But this is not a sell-off which is going to continue. This is just a very temporary thing. The equity market is going up because the monetary support and fiscal support is going to continue.
So would you say then, we were, Peter and I were just talking about this, Manish, that the clues from the bond markets this time round may not be the best ones to read the equity markets. But when you look at the dollar, it tells a very different story as well, right? Even today, the way the dollar is performing, and you see what's happening in the equity markets. So whatever is happening, you're saying, is a short-term aberration, a correction of sorts. It's not the unwinding.
Is that correction direct? Is that question directed
Manish, that was for you.
Sorry, Nanta, is it for me or?
Manish, go ahead.
Okay, sorry for the confusion. Yeah, so what I'm saying is that when you are doing asset allocation, you always compare the expected return or return that you expect from different asset classes. Take it back to pre-2008, when you used to have interest rates high. So if you felt that the equity market was at a high, you're going to correct, then you would move in an asset class. And if you compare that to when 10-year yields used to be at 5% long time ago, it was easy for you to make a switch. Now, if you want to make a switch from the equity market and the bond market and you see yields as 1.24, you start looking at what risk are you taking for next 10 years. What if there's an inflation? What if there is some other scare that is going to come down the line? So the case for equities remains very strong because of lack of alternative. And of course, cash is an alternative. And one can go back into cash. But then you look at what is going on and the amount of accommodation and fiscal support that is carrying on everywhere in the U.S. and UK and Europe, it is just a no-brainer in my opinion. I think the equity market will continue to go up. The growth stocks are going to be volatile because those are newer markets and newer growth that is targeting. But as it has happened over the last 2 or 3 years, as we have seen for growth stocks, they will continue to rally. So in my opinion, there's absolutely no doubt that the equity market will be well supported. And volatility is not a risk. That's what one has to bear in mind. That is an opportunity in many cases. The risk you take based on whether you should hold a particular stock or not, or a particular company or not, that's something you will have to still do your homework on. But I don't think that vol should be seen as a matter of risk, which is what the natural way of thinking in the market is. Vol means it's risk. No, I don't think so. I think it's based on whether a company will exist, do they have a real revenue, are they going to grow? That is the risk that you're taking. And growth stocks offer a huge deal of opportunity, I would say, in many years in the future.
So let's leave it at that for tonight. Peter and Manish, thank you so much for joining us live.